Hey, what's up guys? In this video, I'm going to try and value Alibaba. I'm going to do a financial statement analysis and use a discounted cash flow model and try and come up with a fair value for their stock and see whether it's a good time to buy. If you're new to the channel, my name is Dan. I'm a business school professor focused on investing. So if you're into investing, hit that subscribe button to see more videos like this one. Alright, let's get started. Okay guys, so I'm at Alibaba.com. If it looks familiar, it really should, because this website is essentially like Amazon.com for people in Asia. So Alibaba's main business is their core commerce, accounting for about 86% of their revenues last year. But they're also jumping into cloud computing here, which brings in about 8% of the revenue. And they got some digital media and entertainment, and they got some innovation initiatives. Here's a quick snapshot of Alibaba's balance sheet. They have a liabilities to assets ratio of about 32%. They're very underlevered there. You can especially see that when you just look at their debt. Their long-term debt to assets ratio is about 8.2%. The current ratio, which is a measure of liquidity, is just about 2. So that means their current assets are about 2 times their current liabilities. Again, very safe there. The interest coverage ratio is above 20. So their interest expense is eating up, less than 5% of their profits. Very safe company. They got enough cash to just pay off all that debt if they want to. So their balance sheet is an A+. Here is a DuPont analysis where I'm going to take the return on equity and break it down into its 3 components. So the return on equity doesn't look super impressive. It's not bad, ranging from 16% getting up to 23% in the year of 2020. But, it's not super impressive. The thing to remember here is that they're very underlevered when you look at that equity multiplier. So they could very well easily double or even triple that return on equity just by changing their debt structure. Now, as far as the fundamental return on assets, that's made up of net income margin, asset turnover, this company is very interesting for a retailer. Most retailers have very high asset turnover, very low margins, but really kind of the opposite at Alibaba. Net income margin is pretty darn high here, just about 22% in the most recent year, and even higher in years previous. I would have to estimate an average of around 26%. So that means for every dollar they sell, they end up keeping about 26 cents in profits. That's very good. Whereas their asset turnover is not so great. For every dollar of assets in place in the most recent period, they generated 46 cents in sales revenue. So I'd like to see them improve that number. But overall, it's actually a very impressive profitability given how underlevered they are. Okay guys, so at this point in the video, I'm going to use an intrinsic valuation model to try to figure out a fair value for Alibaba stock. To do so, we're going to use the free cash flow from equity model because the company does not pay any dividends, and so it's more of a potential dividend model. It's going to work a lot better for us. Now, to make the model work, we need a discount rate. I will go with a medium-ish discount rate. I think Alibaba's business is wonderful. I think their balance sheet is amazing, but they are located outside of the US, in China in particular, and the accounting standards there are not really the same as they are here, and the regulations and institutions surrounding those standards. So we have kind of an information risk, I would say, elevated information risk for these companies. And so that's why the discount rate will not be super high, but will be higher than it normally would. I also need to estimate those free cash flows from equity for the next 10 years or so, and then figure out how much they'll grow after that. To do that, I'm first going to have a look at their revenue growth and then kind of map out a path to show you guys where I'm getting those free cash flows to equity from. Okay, so what we see here is a very high analyst interest in the company. You got about 44 analysts forecasting next period's earnings. They are expected to be, $108 billion in revenues. The following year, they're supposed to grow by another 30%, go up to $141 billion, and so on. you can see a very impressive growth streak here, and I'm going to be incorporating these numbers into my path to achieve their free cash flows. Okay, so before we do this forecast, let's have a look at their reinvestment needs. Any company that's growing is going to need to make some reinvestments back into the company to achieve that growth. Growth is not free. What we can see here is that this company does do some net capital expenditures in the most recent period. That was close to $8 billion worth of that. They also invest heavily in R&D, and they do some acquisitions. Acquisitions are a little more bouncy here. Some years it goes down to zero. They don't do any acquisitions. Other years it goes higher there, getting up close to $5 billion. We're going to have to take kind of an average of this, and we're going to have to incorporate that into our forecast. Okay, so here is the path I see for Alibaba. Their revenues, I predict, will grow like this. Remember, next year, analysts are forecasting $107 billion of revenue. The following year, $129 billion, and then $155, and so on. We really had a full forecast there. Now, I don't really trust forecasts after about 3 or 4 years. I think that's very hard to do. So I kind of just have them growing at a reduced rate after that, ending up at about 8%. After that period of time, I expect they're going to grow at some perpetually low growth rate. If they achieve this, you kind of got to have a reality check, make sure this sounds reasonable. That means they'd be bringing in about $366 billion in revenue at that point in time. Does this sound reasonable to me? Well, actually, yes. When I look at how much Amazon is bringing in the US, and you look at the population over in Asia, that doesn't sound that implausible to me. Next thing is the net income margins, right? You got your revenues. Now how much do you get to keep as profit? Well, for me, I went with their historical average of about 25.3%. I think their margins could in fact improve, but I'm not going to be that optimistic. I'll just say they stay the same. That gives me net income. The final step, of course, is reinvestment needs. And the more they grow, the higher those needs are going to be. As you saw from the last section, they do some CapEx, they do some acquisitions. So I'm going to have them reinvesting about $10 billion of the $21 billion, or I'm sorry, $10 billion of the $27 billion of income they earn for a reinvestment rate of about 40%. That reinvestment rate is then going to drop as their growth drops. Remember, you've got to do reinvestments if you're going to grow. This gives us a stream of free cash flows to equity, and let's see what the fair value is. Okay, so I'm taking that stream of free cash flows to equity, and I'm going to discount them back to present value using a 7% discount rate. I'm then going to add them all up. I'm going to add the terminal value to that, plus I'm going to add the cash on the balance sheet, put it all together, and my calculations show that this company is worth over $1 trillion for an intrinsic value per share of $442.67, making it very undervalued. If I instead use a 10% discount rate, I'm left with an intrinsic value of about $260 per share. So if you believe this company warrants a higher discount rate, it's still really a good deal under these assumptions. Okay guys, so here are my final thoughts on Alibaba stock. First thought is always to hit that like button. It really helps the channel. But okay, seriously, second thought is this. I think their balance sheet is extremely safe, assuming we can trust those accounting numbers. That's really the only fly in the ointment here, if they have some kind of restatement and they were actually lying to us. But this company has actually been around for a while now. They've been growing for a long time. And I personally view them as a little bit safer than your Chinese startup company. So that being said, they have an excellent balance sheet, excellent profitability. Really love what I saw with the DuPont analysis there. Definitely want to buy the company. Is it worth it? According to my calculations, it really looks like a great deal. It looks honestly like too much of a good deal. I started to get worried about it here. So I just changed the discount rate to make sure I had a little room for error there. And look, you definitely got room for error. So For me, it's definitely a buy. I'm going to be buying some. So let me know what you're going to do in the comments below. I appreciate your thoughts on this. As always, thank you guys for watching.